Ladies and gentlemen, welcome to the Maverick Mindset Radio Show. I am Adam Williams.
And I'm Ashley Muckenhop.
And this is the radio show for the dreamers and doers. It's for those who are willing to step into the arena.
Some call us the crazy ones, the misfits, the rebels, the troublemakers.
We don't accept the status quo. We leave the world better than we find it.
We approach each day with an enthusiasm unknown to mankind. We maintain a rational optimism about the future.
This is the Maverick Mindset Radio Show, brought to you by me, Adam Williams. We're back again.
Finally.
Man, that was...
It's been a minute.
It's kind of funny. So we were gone for, I think it was 35 days. I think I counted wrong. So we were gone for 35 days. So we skipped probably 4 episodes.
Yeah, the last month.
Although
pretty much.
We recorded one.
We did.
Which will be good.
Yeah.
More to come on that. But
it wasn't the same.
It wasn't the same. And it's pretty interesting because it took me until we returned from the trip to get it, right? We went on a 35-day road trip.
Yeah.
And I don't know, I came back with this expectation, or I left with this expectation of I got to get something out of this.
Yeah.
There's got to be some epiphany or some moment. And it didn't happen until we got back. And what I realized was, well, 2 things really, but one, my word for the trip, Jackie and I haven't even talked about this because we jumped back into work when we returned, but it gave me a lot of perspective on how big this country is, how vast this country is, but also how empty, but also how full it is at the same time. So, we spent a lot of time in Moab, Utah, which is this tiny little town. But there's all kinds of small businesses there. There were 6 or 7 bike shops in this tiny little town. Now, of course, there's a lot of biking going on.
I was going to say, is that a popular
thing? So that my word was really perspective. And now that I've come back, and really what I did for 35 days is I broke every single habit I have. Every routine. No.
Why?
Because I have good habits.
Maybe you need to reset.
Well, that's what it was, is I kind of cleared the deck.
Yeah.
And reset everything and said, all right, turns out that some of the stuff that I was doing.
Some habits need to be broken.
Totally. There's a lot of routine stuff that I was doing that I needed to get over. And then there's a lot of stuff that I need to get back to now, which I'm slowly getting to.
It would be hard to make the transition back, right? I just want to keep on going. It'd be hard to come back.
I think the rest of the family was done. We were in Indianapolis for the last night of the trip, and I think everybody else. Oh no, we did an extra night in Ohio. That's right.
Yeah.
But I could have kept going, but I think everybody was ready to get back, and I'm glad we're back, and we're back live.
Yes.
Blowing your minds every Wednesday at 9, going live at 9:05. Today is show number 59. Mm-hmm. We have our favorite guest here today.
Our favorite.
Who I just spent 35 days in an RV with.
And we're still together.
And we're still best friends. And I'm going to warn you. I'm going to warn you right now that your headset is messing up your hair, and you're not going to like how that looks on camera.
That's what love is all about.
Before we really jump, see, I'm looking out for you. So today, show 59, we have Jackie Williams here as our special guest. Mm-hmm. We are talking about the big things business owners need to know about the big beautiful bill because, well, we were gone. It passed.
Yeah.
And the president signed it into law, and now we've got something to sink our teeth into. We did a show on this a few months ago, and it was sort of, here's what we think is going to happen, and it hadn't passed the Senate yet, but now here we are, it's law. So many exciting updates, and we are going to dive into this thing today, and probably we'll end up doing more than one show on this, because it ended up as 900 pages or something.
Yeah, it's insane.
So there's
900 pages. Oh my gosh.
900 pages of new tax law and
there's
other
stuff. I was going to say,
there's a lot of,
But there's a lot of fluff, of course.
Yeah.
But
Well, because I think, Jackie, you said the other day, you don't just pass a tax bill, right?
Unfortunately, that's not.
Well, and we'll get into this, but one of the really discouraging things is there's a lot in here that we're going to talk to, and there's a lot of concrete stuff, but there's still a lot of stuff that the IRS has to do. They have to change forms and offer guidance, and so one of the examples is there's no tax on tips, and they need to create a regulation that says it's only for certain industries or certain jobs that typically receive tips. So radio hosts will be exempt from this, right? But so they've got to make a list of industries that are typically receiving tips so that people know whether this part of the law applies. Well, that doesn't exist yet.
So they have to do some stuff.
And I'd be shocked if they get that up even by the end of the year.
I read somewhere, and tell me if this is true or not, that this whole thing too is supposed to help the IRS audit more, right? It's supposed to help in how they audit, and it's supposed to make it more, what's the word I'm looking for? More.
I'm not so sure about that.
Yeah.
There is a lot of compliance stuff, and this is a big
Maybe
concern.
that helping people be more compliant, so it helps them in order to.
Well, it helps the government enforce things, and
Maybe,
and some of these provisions that we'll talk about are temporary, and
Okay.
we'll discuss the impacts.
And
of
some
that.
of them are permanent.
Some of them are
In
permanent.
air quotes.
Yeah. So there's a lot still to come on this, but before we jump into it, every Wednesday, blowing your minds every Wednesday at 9, going live at 9:05. As always, we are streaming live on Facebook. Check us out at maverickmindsetradio.com for more information, including Maverick merch. You can also find our prior episodes on Spotify, YouTube, and Apple iTunes. And then, of course, follow us on Instagram. We're low on Instagram followers, despite my consistent posting there. But we'll keep it going. So, all right, let's not waste any time. Let's get into this today.
Yep.
Where did we decide to start with this?
Like the 5 main
Yeah.
topics.
So, I mean, we ended up with more than 5.
We did,
Of course,
yeah.
yeah.
Like, ooh,
Yeah.
I get really in the weeds sometimes, and I get like, oh, here's another one, Ashley. We're going to tell them about
I
this.
know, yeah.
But again, it's 900 pages,
Yeah.
and I
Yeah.
think that's one of the things that Ashley, you and I have talked about this before. There's a lot of people that are very worried about what's in this bill. How's it going to negatively impact me? What benefits am I going to lose? What's it going to cost me, et cetera, et cetera. And I think the reality is there are opportunities like anything else in this bill for the people that are looking for those opportunities and know how to find them.
Right.
Well, we have one of those people sitting between us
Yep.
who spent the time looking for the opportunities in this bill.
Yep. Yeah, so I think we talked about, you were going to go over, Jackie, the 5 topics business owners, you know, and obviously we came up with more.
Right.
But the top ones that we
Yeah.
want to try and cover today.
So I think just to get started on the first one that everyone seems to be like buzzing about and everything that everyone was so excited about, so probably not a surprise, so let's just get it out of the way, is bonus depreciation's back at 100%. And it is permanent. So unlike last time, for all you business owners out there that might have been familiar with bonus depreciation, so TCJA, the Tax Cuts and Jobs Act, allowed us to take 100% bonus depreciation for a while, and then it scaled down. It was 80%. I'm all screwed up in tax years. Not last year, but the year before, 60% last year, and it was supposed to be 40% this year, meaning that 40% of qualifying assets could be depreciated all in the first year.
So can I use some non-accounting jargon to explain
Yes, please do.
depreciation, and then you can
I was
explain
gonna say,
depreciation.
what is
Yeah,
it?
absolutely.
So for those who are non-accountants,
Yes.
if I go out and buy something for my business, if I go out and buy a notepad,
Yeah.
and it costs me $5, I can deduct $5 from my income on my taxes.
That's right.
Okay. Well, there are certain things that the government says, well, that thing that you bought actually has a useful life that's more than just this year that you bought it. So you can't write it all off this year. You got to spread it out over a period of time.
Right.
So if you buy a piece of real estate, you can
Yeah.
deduct it. If you go out and buy $1 million piece of real estate this year, you can't write off $1 million this year.
Right.
Even if you paid cash and spent all of that money, you can't write it all off. Instead, you can write off a little bit every year for 27 and a half years.
It depends on the type of real estate. But yes, generally.
So rather than writing it all off this year, you can take a little bit every single year.
Is that how it always was, or is that a change?
No, that's how it.
Well, I don't
that's
know.
All
There
it,
always
that's how-
was is a tough question because there always hasn't been income tax.
Right, and I haven't been around as an accountant for that.
Yeah, that's fair.
I can't speak
As boring as accounting is,
Yeah.
can you imagine studying the history
history.
of
No.
accounting?
It's like, yeah.
All right, now I have a new thing to research.
Yeah, there you
All
go.
I can tell you when it started and the ledger system and all that, but I don't know all the.
So that's the general rule. So for example, if you went out and bought a vehicle or a piece of equipment or a piece of machinery in your business, you have to spread it out over a period of time, and it's
Oh.
different for every type of asset
Yes.
class depending
There's
on what you
different
buy.
lives.
So they've created this new rule that says, you know what? We're going to do you a favor since you spent all that money, and we're going to let you write all of that off this year.
Okay, so that did change. So now you can do all of it.
For
For certain
things.
ones.
Okay.
Well, wait, hold
Man,
on.
this
Let's
is-
get the disclaimer.
I'm
in
trying.
there.
Yeah, I'm trying to get the rule in place,
right.
and then we can talk about all of the exceptions. And this was part of our prep for the show. Is like we can't just jump in and talk about the exceptions. We have to explain the rule first.
Yeah.
So, the rule is you have to depreciate assets, not just write them
Yes.
off in the year that you acquire them. It doesn't matter whether you pay cash or borrow money or finance it or whatever. So, a few years ago with the Tax Cuts and Jobs Act, they created or boosted, I guess, bonus depreciation and said, hey, there's certain things that you can write off faster and you're welcome. But like Jackie said, it was scaling down and it was phasing out. Well, now they've brought it back.
Yes.
And it's 100%. So tell us some of the things that you can buy that this applies to that you can write off 100% this year. Although, let me put the one other disclaimer in there. I think you have to acquire it and place it into service after January
19th.
which was
Yes.
Inauguration Day.
Yes.
So if you went out and bought an expensive thing in the first
Yeah.
18 days of the year, which any tax strategist would have told you not to.
Well, they didn't know.
Yeah, I would have advised against it at that point to wait. Let's wait and see. So
Well, yeah.
so now they've made this retroactive that anything that you placed in service since January 19th.
Yeah. So I don't know that. Yeah.
So what types of stuff?
So
are we
what
talking
types
about?
of stuff?
Like why are people excited about this?
Well, what's exciting is, so here's a couple things. If you are in the market for a bigger asset, like a vehicle, right, that meets the requirements for bonus depreciation, vehicles are normally depreciated over 5 years. You can take, there are other provisions depending on the different types of vehicles it is that you could take 100% in, the first year. But bonus depreciation has a lot of benefits if you're buying a vehicle over that 6,000 pounds, right? And
GVWR.
yes,
Which is important.
gross vehicle weight rating,
Yeah.
right? And so if that hadn't gone into place this year, the most that you could write off in year one would have been 40%.
Okay.
Now it's at 100%. So that if you're having a big taxable income year, that's great for you. So that's one example.
Yeah, so the common example is you see the business owner out buying a new Escalade or Suburban or
Yeah.
G-Wagon or truck, big fat heavy vehicle. And it's not just for construction people
Yeah.
who are driving their truck. Like there's ways to make this qualify. This is why since 2017 you saw business owners getting new big fat heavy vehicles every year or 2 years because they could write off 100% of it in the year that they bought it.
Is it buying or leasing? Or
This is for buying.
Buying.
Okay.
Yeah, and you can buy it through a loan. You don't have to pay cash for it. But
So that's
Yeah.
the really fun strategy is you can buy this. You could buy this thing now. It's
Yeah.
we're more than halfway through the year and place it into service and write off 100% of it this year. You're only going to make 6 payments through
You
the
say
end of the
place
year.
into certain. I mean, you need to start.
You
you need
need
to
to
use it for
You
the
gotta
business
prove it
in the
using
business
it.
purpose.
Got it.
So that is
tracking
very
it, right?
important.
Yeah.
Yeah. So
Well, and this is where people get stupid and greedy is they say, well, I'm using it for business, but they don't track their miles and
Got
there's
it.
no documentation
Yeah.
and there's no paperwork in place that will never stand up under
Right.
audit. So there's
Yeah.
good and bad ways to do this. But this is why it's exciting because for business owners, if you're in the market for a new vehicle and you want a big vehicle, or if like, and I'm talking for the people that are kind of stretching it, right?
Yeah.
Like, yes, my 3/4 ton pickup truck is a business vehicle in our business, even though I work in a law firm,
Right.
an
Yeah.
accounting firm, right? So even outside of those more traditional, like, oh, I need to go and buy a fleet of trucks for my construction company, right?
Okay.
We're all excited about this because this is a common way to use it. Is it a huge tax savings? Yeah, for this year because it accelerates a lot of your expenses.
right, it's a timing difference.
so
Yeah.
it's-
So if you're a business like a construction, can you go out and buy multiple vehicles and write them all off, or how?
Well, I mean, you have to have a business purpose, right? Because that's really what's going to allow the write-off. So, I mean, if you are one person, like let's say you're a solo
Okay.
law firm owner that doesn't have any employees to drive those, you don't need
Yeah.
5 trucks.
Okay. Easy on the word need and with the number
Well,
of vehicles.
Okay. And the IRS is going to struggle to understand in case
Why?
if you don't document
The
and prove
IRS
it.
struggles to understand everything. Yeah. All right.
Well, they're going to struggle they're not going to struggle getting it
Yeah.
from your wallet.
Yeah.
Those tax savings back. So I guess so further on that, this time we're not seeing that declining scale, getting kind of back to where we were with the benefits here of this provision. We are going to see 100% permanently. Now, every accountant out there, everyone that's talking on this topic, every time they say permanent, it's like this when you watch them on the YouTube podcast.
That was air quotes.
Yeah, so if you're not watching us on YouTube, I'm air quoting all over the permanence. The idea, though, is there's no definite expiration date, right? There's definitely no sliding scale down with it being put in place. So kind of pivoting out of it, did you have anything else you want to talk about there?
To answer Ashley's question, isn't there a cap on how much bonus depreciation you can take?
There's a cap on how much Section 179 you can take.
Okay. And there's obviously a difference between those two things.
Yeah, I mean...
Like, what is that?
Yeah, if we're technically... bonus depreciation has different provisions than Section 179. For example, Section 179 depreciation, you can't take it into a loss position. You can only take it up to. So
you can't take 179 to completely eliminate your income for years and years and years. But if you did go out and buy all those vehicles or the machines or the equipment this year, you could use bonus depreciation to put you into a loss position, which actually helps on your taxes next year too.
Yeah. So under Section 179, there are opportunities to take accelerated depreciation. And so 179 has been in place. It's separate from this bonus depreciation, but you can only ever take it to zero to your business to zero.
Gotcha.
Bonus depreciation lets you take a loss that would then offset other income you might have. So if you are, for example, an S corporation and you take a W-2, or you have a spouse that has a W-2 outside of your business, you could actually reduce your income even further by, if you end up in a loss position.
So let's get back to bonus depreciation, because the vehicles one is like the obvious one, because it's fun to talk about and it's exciting, especially for car people who like to have new cars or a fleet of vehicles or, my friends. But we're also excited about bonus depreciation for cost segregation studies.
Yes.
So can you explain a little bit about that?
So in your example before about real estate, right? So we go buy a piece of real estate, whether it be for commercial purposes, it's an office building, or it's being, an Airbnb actually is considered a commercial depreciation schedule. Or you have you buy a residential building that is being rented, maybe long-term rental. Typically, your depreciation schedules are going to follow that longer life. So for the residential, 27 and a half years. So commercial, 39 years. When you do a cost segregation study, you have an expert come in and take a look at everything that builds that property, that makes up that asset. And they will go and find items within the asset that have... I always say younger. I don't know why. Shorter useful lives. They're not younger. They're probably older because they would depreciate faster. I don't know. So anyway, that's how my brain works sometimes. Yep. Anyway, so you'd go in and you'd find the 5-year property. You'd find 7-year property, 15-year property.
So we're back to the government says there's certain classes of things that you can depreciate over a certain amount of time. The cost segregation study, they come in and say, well, you've got some stuff in this building,
right,
in this class, and some stuff in this class, and some stuff in this class,
right. And it's so if you don't get that done, it's just like the whole value of that real estate is at that 39 or that 27.
So this splits it up.
This splits it up. This
so
says,
you could take
okay,
it sooner.
Yes. Oh. And so when there's bonus depreciation, it's not just that acceleration to the useful life time frame. It is, if that useful life also puts you into bonus depreciation, it's even more accelerated. So that's
so without it, you'd have to wait all those years to be able to take advantage of it. But now this allows you to take that at different times.
Sooner. Yeah, sooner. So something to think about. I mean, is if you're having a higher tax, timing is everything with these opportunities, right? So again, bonus depreciation, like we talked about, isn't additional tax savings. It's just timing that tax savings.
Which for most business owners, the rule is we want to accelerate our expenses and defer our income.
Right.
Because that's gonna shift that tax burden. That's gonna put more cash in our pockets now to reinvest in our businesses. So, the general rule is that's what you want to do is accelerate your deductions, which bonus depreciation allows you to do. Now, there's exceptions to that, which I don't even want to get into right now.
Right.
But I do. So one of the examples that we use sometimes when we talk is if someone goes out and buys a $1 million building, and let's assume it's a residential investment, right? Not commercial. Commercial is even worse on this initial scenario. So if you go out and buy a $1 million building and you have that 27.5-year depreciation, you can write off 3.636% of that value every single year. So you spend $1 million on a property, you can write off $20,000 of depreciation this year, which if you're in a 30-ish% tax bracket, that's about $7,500 of tax deduction that you get by buying a $1 million property.
Mm-hmm.
If you do a cost segregation and they come in and say, all right, in this $1 million property, you got about $100,000 of stuff that's like 5-year category, and you got $100,000 in 7-year and $100,000 in 15-year. You can make such a big percentage of that, potentially a big percentage of that property, depending on the property, which is why they do these studies. In the example that we've used, a $1 million property, instead of a $20,000 depreciation expense, you could write off over $200,000 of depreciation. So you've got, if we say 60% of it is eligible for bonus depreciation, it's a $70,000 tax deduction versus a $7,000 tax deduction without
That's
bonus
insane.
depreciation. It's a 10x.
Yeah.
So that's an example that we use commonly. Now, of course, the disclaimer is it depends and every situation is different,
Yeah.
but we've seen that.
Right.
And, and what a great result that was going away. And
that was going to be gone.
yes.
Well, it was
So
going to get
that's
smaller
what,
and smaller.
until it went away. And that's what bonus depreciation is bringing back. Is they're saying if you want to make these big investments, we're going to give you more tax incentives for that now. So it's a big boon for investors, for business owners, for anybody who wants to take advantage of these opportunities. And it also creates incentives to invest, which is something else that they're trying to. They want us to invest in America and make America great again. Well, this is an incentive to go out and do that. Yeah.
Yep.
Ooh, let's move to clean energy.
Okay.
Snooze
That's it. I
fest.
know, but
hold
hold
on.
on.
There's important.
Yeah, because I feel like everybody thinks that's a big thing to do that, right?
Well,
but that's
yeah.
going
So
to,
a lot of those are going away. A lot of people were investing in solar panels and stuff like that because of the credits that were available, and that is on the decline, and it will be phased out. Something to know though, if you're going to get that bonus depreciation, and you're thinking about getting like a Tesla, before you could, get both, right? You get the bonus depreciation and you get a clean energy credit. $7,500 is the general, credit that we would hear a lot about. But we are going to want to make sure that we're making that purchase before the end of September because that is
okay.
going away.
So there's credits available for buying clean energy stuff. Is it only vehicles or is it's?
So there's credits available for clean energy vehicles, both individual, right, outside of the business and business, and then there's also credits available for certain investments that are not vehicle related. So that's like your solar panels. That's different improvements to both homes and commercial.
So this was one of the things that they fought a lot about in creating this law. That we just talked about bonus depreciation. That's going to reduce tax revenue. Well, we've got to do some other things to offset that. So they're eliminating these various clean energy incentives, these credits and things like that. And there was a lot of fighting over this because there was a lot of negotiation over the timing. That they wanted to phase it out in a couple years or maybe next year. Well, the final solution was nope. This is heading for a cliff. This is gone.
Yeah.
So on the vehicles, the credits available for vehicles, personal and business use, right? Yeah. If you're going to buy basically an electric vehicle, or is it hybrids too?
There's very specific requirements. Okay. So I don't want to kind of you should be aware that if you're buying an electric or hybrid vehicle for personal or business use,
you might want to look at doing that before the end of September.
Yes.
And
And
talk
that's
to your
why it's
tax
not a snooze
strategist
fest.
about it to
Yeah.
know
Yeah.
the rules.
So,
Right.
so
Make
we're
sure the
talking,
vehicle qualifies.
So
Yeah.
you've got what? We're almost at the end of July, so 9 weeks.
Yeah.
So
Yeah.
if you're thinking about
9 weeks? We only have, 9 weeks.
end of
Okay.
September,
Yeah.
so all of September, all of
Yep, yep.
August, and a week in July. So yeah, you got 9 weeks if you want to take advantage of this thing. That if you're thinking about getting a new vehicle, personal or business, and if you're thinking about hybrid or electric, you want to know what these rules are, because if you wait until September 2nd, you could leave
Yeah.
$7,500 on the table.
Yes.
Oof.
And that's dollar for dollar, right? Because it's the credit.
Yeah, $7,500
Yeah.
of cash, of tax expense.
So if you really want, if you've been wanting that Cybertruck, right? Now is the time, folks.
They're so
Have I been
ugly.
wanting a Cybertruck?
Can you?
Probably.
They're cool inside, but the outside's like a Lego. It's so weird.
Well,
It's
they're
like-
self-driving
Penny's
too.
obsessed with them.
Right?
Every time she
It's
sees,
like
oh,
It's like
a
a
Cybertruck.
space something. It's
And
so
the,
weird.
the stainless steel is so bad it's so ugly that everybody wraps them. So I think they're awesome. I would get one and I would wrap it in like rust.
That would be like Rust Bucket 2.0.
Yes.
So,
right.
Jackie, question. If this is ending to get one in September and you get a credit for it if you buy, is that something driving an electric vehicle always that you get a credit for every year because you're
Oh
driving?
no, just the year of purchase.
Just buying.
But it's
it.
it's $7,500.
Yeah. Okay.
But like when I bought my Volkswagen, I didn't get this credit because one of the rules was it had to be made or manufactured or something.
Yeah,
in
there.
America.
That's why
Oh.
don't. Yeah, it's not all of them. You need to go.
Yeah.
There's a list. The
There's a
IRS
list.
has a list. So you'll
Although with,
and there's and. I'm not going to get into the details. There's a lot of
there's a
lot of
if you're
nuances.
thinking about buying a new
Sorry.
car and you're thinking about electric or hybrid, talk to somebody about this. Because
Yes.
as another example with the Buzz, I couldn't get the credit because I purchased it. But if I leased it, they were able to somehow factor the tax credit into the lease payments, which was super complex. So there were people that would
rules
lease the
here.
Buzz. They would lease the Buzz. They'd make one payment, and then they'd go out and refinance the lease and buy it out to take advantage of this. Because it's, $7,500 now. It's a lot of brain damage for $7,500.
Yeah, it is.
But some people have time for that. So anything else you want to talk about on clean energy? I mean, there's a lot of incentives phasing out. So we talked about vehicles,
Yeah.
solar panels, if you're going to upgrade things in your house or install, is it like energy efficient windows and doors and stuff
Yeah,
like
those
that?
those are some of them. That's the residential.
Is that's not
Clean energy
September though?
I believe that goes through December 31st.
Yeah, the residential's to the end of the year, but let's be honest. If you're going to
Yeah.
get new windows in your house, you need to be shopping now.
Yeah.
If you want to get
Yeah.
that done by the end of the year. Even remember when we had that door that broke at our office and it took a year and a half to get
Yeah.
it fixed?
Yeah. So that's
Right.
an example of one of those strategies. You can't come to somebody in December and expect to take advantage of it.
Right.
Right.
Yeah.
Yeah. So if there are improvements that might qualify for clean energy, make them as soon as possible. Okay.
Yep.
We
Okay.
can put the link to the IRS
Yeah.
rules on that if we want on the show notes. Could we do that?
Yeah.
Okay.
Yep.
All right.
All right, Jackie. What is OBI? I have no idea. What
QBI.
Oh.
It has a little tail.
OBI is the first half.
I don't know what OBI is. Is that Obi-Wan Kenobi?
Oh no,
Yeah,
I'm like,
it's the first half of Obi-Wan's first name.
Yeah.
Okay, yeah. I'm looking at this and I'm like, guess my glasses aren't.
It did look like an O. It is a Q. QBI.
What is
QBI?
QBI?
So that is the qualified business income deduction.
Qubit.
Yes. I was
Qubit.
like QBI. Technically, I always call it Qubit because that's just what.
Well, so I call it Qubit,
Yeah.
but there are other accountants out there who call it the QBI deduction.
Oh.
And
yeah,
so
just
I
like
did a
ERC
webinar on this
agency.
recently, and there was some accountant that every time I said it, he was in the chat. It's technically the qualified business income deduction. And it's like, thanks, bro. Please go back to your green visor and adding machine and get off my webinar.
Okay. I just had a vision.
Oh, womp womp. I'm the accountant in here. Okay.
But you don't wear green visors.
But she'd look good
You're
in one if she
stylish,
did.
Yeah.
But I do like hats,
I'm
and
going
green
on
is a good
Amazon.
color on me. Yeah. So this was one of the things that was going to go away. Just like I feel like everyone loves to talk about what was going to go away, and I'm like, were we ever going to let it go away? Because here we are. We've been talking about.
We were.
this.
We were. We had to fight over it. We had to negotiate.
Yeah. So I think it was.
I can get a
again, it was
5-pack
not
of green
permanent.
visors for $15.
Great, one for every day of the week.
There you go.
I can wash them. Okay.
Bulk casino bingo visor dealer hats.
Why are we getting a bad rap for accountants? That's bingo players. We have a green lamp. How about that?
That's whatever.
With the chain.
Anywho.
Those
Yes,
lights.
I have
Yeah.
had a couple of those.
You're still
Anyway,
Debbie
we're-
Downers at every turn. All right.
We.
So Qubit.
Really, we?
Qubit was created in the TCJA, right?
Yes.
Okay. Can you tell us a little
Correct.
bit about that?
So this is a deduction, so not dollar for dollar savings, but like a nice little surprise for business income. So you have business income on your 1040, and there is a line for the amount of this qualified business income deduction, and it is generally 20%.
Yeah. So basically,
no
what they said is don't pay taxes on 20% of your income.
Right.
As for business owners.
Right. So you don't have to go do anything. This was just kind of like a, hey, thanks for,
Yeah. So
thanks for being an American business.
If all else being equal, if you made $100,000, you only pay taxes on 80.
Yes.
Thanks.
Right. So this is for any entity that's a pass through or anything that you already like recognize that income. It doesn't qualify for a C corp, for example.
So S corps, LLCs, partnerships, sole proprietors can take advantage of this.
Yeah.
Okay.
So now,
which is why your entity choice matters.
Exactly. And so this is something where, maybe people would have considered that if this would have expired, an S corp maybe wasn't for them anymore. They may have, or in some cases, I have actually seen certain clients where the type of business they have and their filing status, they don't get any Qubit because of the different phase outs. So,
which is often due to a lack of planning.
No. Well, no. So it makes sense for them to be a C corp. And so that the fact that they are in a C corp or we're considering a C corp
but again, there's reasons to review this.
Yes,
right?
absolutely.
Because what we're going to get into the rule in a second, but Qubit has been expanded. It's better now, right?
Yes.
So if you were going to miss out on this 20% income deduction because you weren't planning or you weren't reviewing your entity or you weren't checking on the sources of your income because this only applies to certain industries, then you were missing out on a huge opportunity here. Mm-hmm. All right. So tell us a little bit about what they've changed with Qubit.
So it's been extended, and basically, you get, I don't know, they were talking about 23%. I don't think we ended up landing on 23%. I think that was in the House bill. It didn't pass the Senate. But where it gets phased out, that amount has increased. So meaning it won't phase out as quickly. And it's still in existence.
So if you had a business but you made too much money, you couldn't take it. So if you made $1 million, you may not be able to take $200,000 off of your income.
Yeah, the calculation changes.
Yeah, it's super complex. Yeah.
Yeah, so it considers how much payroll you have, the type of assets that you have, and then from there it's calculated different from the 20%. So likely less.
And this only applies to certain industries, or can everybody who's an S corp take advantage of this?
Not everybody. So, up to that threshold, right? So up to a threshold based on your filing status, you can take advantage of this. I don't know if there are any exceptions, but my expectation is that there are none. I haven't seen any, but that doesn't mean that they're not written in there somewhere that I haven't experienced yet. That where there is kind of a lid on it, if you will, is for certain. Basically, they call them SSTBs. We call them, I guess, as
specified service, trade, or businesses.
Specialized services, trade, or business.
SSTBs.
Yes,
okay.
SSTBs. And who is that? That's accountants. That's lawyers. Yeah. That's consultants. So basically, if it's a service where you need to have a specialized trade, you have a cap. So then if you sell widgets, no cap, for example. And And actually, if you're an engineer, I don't know how they got out of this, but engineers are not considered a specialized service.
But this is a good example because we have law firm clients, for example, who generate income from their law firms that may go above this limit, and they'll get a phase out, or they can't take full advantage of this.
Yep.
But there are legal ways to structure your income in a way that less of it is subject to this cap.
Right.
So maybe you have some income that used to be legal income, but now can be considered something else because of the way that you've structured it or arranged it.
Right. So so maybe that's something that's in a different entity per se. Like maybe you have other entities, just your legal income would, be capped.
Could you so let's say you own a law firm, you make $1 million, right?
Yeah.
And what if I set up my own marketing company and my law firm hired my marketing company? So now that income is marketing income, not legal income. Are there ways to do that?
If it's marketing consulting, you're also an SSTB.
Okay.
I'd say but let's say you had a widget business, right? In that case, you might just want to consider how can you diversify your investments or your businesses outside of a specialized.
That's a very neutral way of putting it. So thanks for that. You may want to diversify your income sources. I'm saying let's shift it out of the law firm. All right. You're better at this than I am.
Oh, thank you.
Coming as a surprise to absolutely no one. Yeah.
Jackie's like, I know.
So they talked about increasing the percentage, 20%. They were talking about 22, 23. I think they left it at 20. The big difference is this was supposed to go away at the end of this year.
Yes.
And it's still in place. So
yes.
And permanent in air quotes.
Yeah.
All right.
In air quotes.
Okay. The next thing we wanted to talk about is R&D. Or they were calling it research and experimentation, I think is some of what some other people were calling it. But I believe it's 2022. Instead of expensing your R&D costs, you're supposed to amortize them.
And what does amortize?
Oh,
no idea.
Yes. So depreciation and amortization
I also
are
want to
cousins.
I need to let you know that after this trip, so we got back Sunday. We're leaving Saturday for Vegas, right?
Yeah.
So I'm like,
It's like a quick stop.
I
here.
got 6 days to detox. So I had ChatGPT create this whole detox plan for me. And today is plant-based. I'm not eating any meat today. But it also advised me not to drink coffee.
Bad idea.
And I don't know if you've met me, but I drink some coffee.
Yes.
Okay. So I'm on day 3 of no caffeine.
How are you feeling?
Well, I'll tell you after the amortization explanation.
Okay.
Oh, but all right. So I'll make it real easy for you. Okay. Amortization is a cousin of
I just wanted to let you
depreciation.
know that you teed that up so perfectly. Thanks, Ashley. You're a great co-host.
Yeah, you're welcome.
Once every 59 shows.
I know. You just gotta give me a minute.
Mm-hmm. All right. So research and development. The government said you have to amortize it. You can't expense it. You can't deduct it.
Yeah. So
what the heck does that mean?
Right. So just like we have hard assets like buildings, like cars, that we use that. We don't expense it because it's an asset. We're going to use it over the life of something.
It's got a useful life. Yep.
In accounting, when we build intangible assets, which is like research and development, maybe it's your customer list that you've been building. Let's take the customer list out of it because I don't want to confuse people, because we don't need to worry about that from a tax perspective at this point. But they don't see research and development as a direct expense. This is a product you're building. This is going into building an asset. So they wanted to.
If I want to invent a thing, a widget,
yes.
I'm going to invent a new cell phone.
Yes.
Right. And instead of being a handheld phone, it's going to be something that you wear as a headband.
Okay.
So I'm going to spend money on engineers and scientists and designers and prototypes.
Yes.
And it's going to cost me $3 million this year to invent this thing.
Right.
I can't write off that $3 million this year?
No. Well, you
couldn't.
They just changed it back.
Yeah.
You can
So
expense now.
Prior to this, I would spend all this money inventing this thing that may flop. I may spend all this money and I may put it out on the market and I may not sell a single one. And the government said, great, take that $3 million that you spent inventing that thing and you can write off a little bit every year for a certain number of years.
Yeah.
It's horrible.
Right. Yeah.
All right.
Exactly.
So they fixed that.
Right. Well, yeah. So, and it was only like that for a little bit of time. I think 2022
There were a couple years.
was the first year that they did
But
that.
again, if we're talking about we want to incentivize businesses to invent,
Right.
to create, to invest, to do stuff that
Right.
previously made America great, then we want to incentivize that. Well, making them amortize their R&D expenses wasn't incentivizing that.
Exactly.
All right.
So that is, so expensing is now going to be allowed. So
what types of businesses should be paying attention to this, right? Because this is not every business does R&D.
right. So if you're, I mean, now you can expense it anyway. But
Can I tell you what my thought was, and you can tell me how wrong I am?
sure.
My general advice to people has been, if you're inventing or creating or prototyping something new, you should look into this credit.
Okay. Well, now hold on. Remember, because we're just talking about deductions right now. We're not. Yeah.
For those of you not watching, Jackie just put her hand up in front of me like a stop hammer time. All right. So I'm
not having much coffee, you're moving pretty fast, buddy.
All right. So well, try and keep up. All
Okay.
right,
Okay. So this is, I don't remember what your question was.
so thanks for listening. My question was, what types of businesses should be paying attention to this?
Okay. So if you are creating something, if you are testing something, if you're building something that's testing. So I see a lot of people in the space where you're coding. You know, if you are in a place where you're building a widget and you have to, you know, a lot of people who, you know, maybe are making molds or something like that.
Creating something new.
Yes.
Right. This
Creating
isn't,
something new.
you're assembling your 17th dumpster of the month. You're just building stuff. Not to
There's no
you're
research.
building things. You're not creating new. You're
Right.
not experimenting.
Yeah. So, I mean, now they don't have to worry about the amortization. They can just expense. But so
Would fabricators be a good?
Yeah,
right?
that's a
'Cause
great-
They're creating new molds and things.
right. Yeah. So, so then we also have this, you know, concept of the R&D credit, right? We've talked about before. And that's what you went to. So right now we're saying you can deduct these costs. You don't have to hang them up and kind of
Hang them up means put them as an asset on your balance sheet.
Yes, and then
depreciate
them, but with the word amortization.
Sorry for getting hung up on that.
Okay, counting jokes. So the R&D credit though doesn't go away. You can still do the R&D credit.
Oh, that's a different thing.
It's a different thing.
Okay.
So these are you're allowed to deduct. How does this play with the R&D credit? Well, the R&D credit, remember, is going to be dollar for dollar tax savings. So if you go and get the R&D credit, you just need to reduce those deductions. So,
Yeah. So there's this is about to get really complex, but there's a deduction where for every dollar of deduction you save your marginal tax rate, whatever, 30 cents, and then there's the credit for every dollar you spend, you get $1 deduction on your taxes. And there's caps and limits and calculations, but you can do both in some circumstances.
Right. Yes.
Cool. And how much planning does that require? Is that something that I can sit down in January and say, here's what I spent last year and here's
There
what I
is
get?
some, to get the credit, you can retroactively go back and get it. I mean, I've seen, you know, I recommend professionals specifically in that credit to help you with it.
So I know one of the conversations that we've had around the R&D credit is like you may be hiring an engineer to go and create this new thing, right? But not all of their time is dedicated to that thing. So it doesn't mean that you can write off or get the credit for all of their wages. It may be like a percentage. Well, 40% of your time was on something new and 60%.
Yeah, it's like a calculation.
Yeah, okay.
Yeah.
So there's some documentation and
a lot of
calculation.
documentation for the R&D credit.
Gotcha.
So if you don't want to go down that documentation, you don't want to hire a professional to like make sure you get that handled correctly. At least now you can expense more. And I believe that there was talk about potentially some retroactive, but I don't want to misspeak on that. So
Again,
more to come on that.
If you create, build, invent, prototype, huge incentives out there for you.
Yes.
Big change.
I want to skip to the tips and overtime because I think that's a big one that
Yeah.
people want to know about, but also I didn't know till you said it the other day that it's not something you don't have to report. Stuff you have to report. It's a deduction. So explain, because
Yeah.
I think everybody's hearing it and being like, I don't
Well,
have to report.
let's get this out of the way. Everybody who's ever worked as a server ever has underreported their wages.
Always.
And every server prefers cash tips because those are going directly in their pocket and not on their 1040. So, like, I don't want to seem naive with this. Like, obviously, we're all committing tax fraud.
Yeah.
Oh, whoa, buddy.
Well, if you knowingly tip a server in cash and you know that they're not reporting it, you're complicit, bro.
Yeah.
I don't know that they're not reporting it, though. I would hope that they're reporting it.
Yeah, okay. I would hope so, too. I hope for a lot of things, which is why I live in such a constant state of disappointment. So that's a general rule. Now, where this has changed over the last few years, like when I was a server, 20-some years ago, most of my tips were cash. But now that's changed, and so many people pay with credit cards. So a lot of it shows up on credit cards, so there's a paper trail. So a lot of more of those tips get reported now because there's evidence. There's a smoking gun. So let's talk about a little bit about no tax on tips, because that was a campaign trail promise that has become a thing. What I learned on this one was, like, I guess Trump was like sitting in his casino in Vegas, and one of his dealers was like, yeah, I hate paying taxes on my tips. And he's like, okay, we'll eliminate it. And here we are.
Yeah.
He did it. Sorta.
Yeah. So
it's close enough that he can claim victory, and he continues to deliver on his promises. And any way that it fell short of this promise, he can blame somebody else.
Yeah.
That's a win for Trump.
I was trying to see if I had the exact. So here's the thing. You're not going to immediately see it in your paycheck if you're a server, for example. And because it is not that, they just there's like a fairy wand and like tips are just free income. It is a deduction, and it actually has a phase out. Like, it has a cap. So so you'll see you'll see that everything is still going to be taken out of it. It's just a deduction from on your tax return.
Your tax form, and this is one of the things that the IRS has to change. Your tax form will say you made $50,000 and $25,000 of that was in tips. You don't pay taxes on that $25,000. So $50,000 minus 25, you had 25.
So now you're only paying taxes on the 25.
Yes.
Yeah.
But you're still reporting all of those tips.
Yeah.
Now, curious to see what happens. Will people suddenly start reporting cash tips? No, come on, let's be serious. But for the credit card portion of it, they're all going to be reported, and it's a deduction. So the IRS knows you made that money. You're just not going to pay tax on it.
Nice.
To a certain to a cap, right?
It's a $25,000 cap, right? So so if you make more, 25 if you're single, 50 if you're married, probably filing jointly.
That's I have there again. We can.
Yeah, I don't know that.
The IRS actually has a link.
There is a cap that if you make more than 150,000 single or 300,000 marrying filing jointly, you don't get any more benefit from this. So. This isn't going to help the server at a really high-end restaurant that's making $200,000 a year.
Right.
But this will help most other servers and card dealers and typical tipped
people that
industries.
Get tips.
Yeah. Now, interesting, because it seems like everybody gets tips in the last 5 years. I had a construction company ask me, QuickBooks allows me to add tips to my invoices. Should I do that? Absolutely not. Not from a tax or legal perspective, but just from a, come on, are you freaking kidding me perspective? So there's a cap on 25,000. So as an employer, we got to report all these tips, and then somewhere on a W-2 and then on the 1040, it'll be how much tip income did you receive? And
it'll get a deduction.
Included. So, I mean, it's interesting because I'm going to make a blanket assumption, but most servers aren't super high income, right? Most servers are low income and probably not paying a lot of tax to begin with. But this probably won't cost the government that much. I really don't expect that. I mean, 25 grand of tips. I really don't think it's going to cost that much because there's so many other tax incentives out there for low income folks that they're not paying taxes anyway. But there is some probably middle ground there of higher end servers or people who are working 60, 70 hours a week collecting a lot of tips that there could be an impact here. But
So, I mean, and it is kind of emphasizing that the reporting be done, right? So that is, it's interesting.
There's a compliance piece there for sure.
Yeah.
But I mean, you think about the bartenders with the bucket sitting on the bar and people just throw cash into there. Like, are they going to count that and report at the end of the night? Should they? Yeah, because that's how you stay compliant. I have no further commentary on that. How about talking about no tax on overtime? We got a few minutes left.
So
this isn't as great as it sounds.
No. I mean, really, it's
well, let me just give it real quick. $12,500 limit. And it's only the overtime piece. So if you make $10 an hour and then you work overtime and you get paid time and a half, you're making $15 an hour, you don't pay tax on that extra $5 an hour. You still pay tax on the underlying 10.
Right.
So there's some benefit here. You know, again, we're talking, if you got overtime of $12,500 and you're in a 30% tax bracket, you could save $4,000. Not that that's an insignificant amount of money, but this isn't an elimination of all taxes on overtime. This is elimination on the overtime portion of your wages, subject to a cap.
Right. Good job,
Trump's
Adam.
claiming it as a win.
Yeah.
Anything else we need to know on that? Income phase outs for that too, right? If you make over a certain amount of money.
Yeah. And then I do think, you know, with that, it's like, it's not like you have the option. Like, there are rules around whether someone gets paid, you know, is exempt or non-exempt from overtime. So I've had a lot of people ask, like, well, does this mean that I could just make more people exempt from overtime? Or and it's like, no, you have rules around that.
Yeah,
That's
there's rules. The other thing, and this is the thing that scared me from the beginning on this one is temporary.
Oh,
so this is only overtime wages 2025 through 2028.
Yeah.
So let's say you get a ton of overtime, and you're married filing jointly. So then your cap is $25,000. So if you make $25,000 of overtime that you're not paying tax on, right?
Mm-hmm.
It's temporary, and let's call it a 30% tax bracket. So $25,000 that you're not paying tax on, 30% tax rate, you're gonna save $7,500 a year every year for the next 3 years. That's pretty serious money. That's what, $900 a month, probably, right? I don't know how good my math is on that, but that's going to go away. So starting in 2029, you're basically going to get a pay cut when this goes away.
Mm-hmm.
So
don't get used to it.
My advice as an employer has been, you better train your employees on some financial literacy, because an extra $900 a month that they're going to see in their paycheck, or that they're going to get in a tax refund, don't go out and buy a new truck. Right? Yeah. Don't go out and take on some debt that's going to live longer than 3 years, because this thing's going to go away and you're going to have a pay cut. Now, they may see the writing on the wall 3 years from now and understand the damage that could do to the economy and blah, blah, blah. But I wouldn't be betting on that. Yeah. I would be putting this money into some investments or retirement accounts, or I don't know. I wouldn't take on debt. Spend the money, do whatever you want to do with it, but I wouldn't use it to finance something new. I think that's risky.
I wanted to ask, before we ran out of time, because I know it impacts a lot of business owners, but I had heard they brought up ERC again. What is that?
It's
kind
of a nothing burger. They did. It is saying that they're going to disallow Q3 and Q4 2021 that was filed after the January 31st. Date that they had out there. Yeah. All the other ones, they didn't specify the other 2 quarters.
So if you were a really late filer on the employee retention credit, there may be a risk that if you filed after January of this year or last year? Last year.
It was last year. Yeah.
So that was the deadline. So if you filed after January of last year, there are a couple quarters that you may not get the credit for.
Right, but it's really only those 2 quarters that if you were kind of like the recovery startup business that you could get. Those are the ones really that are in flux.
I also think there's going to be some litigation around that, because there's some tax professionals out there that say, yes, the IRS can giveth and taketh away, and just decide that they're not going to do this. But that if they created a law and you relied on that law, and then you went and filed based on that law, and then you're waiting for your money, and then suddenly they say, nope, not anymore. Or are they going to go back to they've already paid some of those claims. So are they going to go back and try and get people to repay that money?
Well, I don't know if they've paid those claims, if they did it based on effective date. So there are some, also some, what's the word? Statute of limitations that they're playing around with there as well.
It's more of the never-ending saga of the employee retention credit. So
I do have a couple more that I guess,
we're going to do another show. We have 30 seconds left. We're going to do another show, because I think there's a lot of other really good stuff that we want to talk about. But this was a good summary of some of the big impact. We didn't even talk about the fact that, hey, tax rates are going down, right? Like, that's good for a lot of people. And I think we should probably spend some time talking about some of the benefits that are going to get cut to people, because there's a lot of fear around that, and I think we could probably dispel a lot of that feeling.
Yeah, there's a lot of ways to
reality.
get away from capital gain tax too that I'd like.
So
to
that's it. The one big beautiful bill has become law. Some of this stuff is affecting you right now, and if you wait too long, you're going to miss out. So get to work on paying attention what's in this thing. Have a great week, everybody. I believe in you.